Morning, everyone. This is Rajashri, and a very warm welcome to all the participants and the speakers, the panelists, and of course, a huge thank you to Deloitte for having taken the initiative. In fact, I would personally like to thank Sunil Shah, who had approached the committee and came up with this idea of running a series of topics in the form of a webinar. I think it is a very interesting concept, and some of the topics that has been picked up is quite informative, practical, and something which I'm sure will be of immense value and help to the participants at large. A very warm welcome to the panelists once again, and I will now hand it over to the host, Deloitte, and take it forward from here. And I wish you guys all the very best. I'm sure it will be a very successful webinar.
Thank you very much. Thank you, Rajshri and BCCI for organizing this, and I'm grateful to all the participants who have joined. We really hope you have an interesting session for the next hour. I hope I'm audible. My name is Anandorup Ghose, and I have the pleasure of hosting today's webcast. I have with me my colleagues Aarti, Mousami, and Anubhav. Between the four of us, we have more than 20 years of experience at an average in working with organizations in helping them design and implement stock-based compensation awards. I'm also delighted to have with us Abhay Mathur. Abhay is the SVP for Finance and Legal at Urban Company. Prior to Urban Company, he spent almost 2 decades with Hindustan Unilever and across a range of areas, and he currently works with Urban Company in helping the organization provide high-quality services to its customers. Between the five of us, we'll address different questions, and we will walk you through the content that we have today for this conversation. I just wanted to remind all of you, and you're used to seeing this format, but just as a reminder, you are all on mute mode, and therefore any questions that you have or comments, etc., please put it in the Q&A or chat box, and at the end of the session, we will take as many questions as we can address, given the amount of time we might have. So as we start this conversation, I wanted to basically talk about the fact that all of us have seen many of us have experienced being awarded stock-based awards in our organizations, and this is not a new phenomenon. We've seen stock-based compensation across companies for the last 60 to 70 years. And while it has seen a lot of traction in technology, new age companies, financial services, across industries, organizations have adopted stock-based compensation as a mode of rewards. India has actually seen, and this is not just a phenomenon that you see in the West. It's a phenomenon that is very actively used in India, and and most companies in India have seen a fair degree of success in the area of stock-based compensation. What we have seen actually is that if you look at a recent survey that we had conducted, almost close to 70% of companies in India have some form of stock-based compensation, and what you see is that it varies across different industries in terms of what percentage of companies are using it. But it's important to highlight here that pretty much every industry has a large share of its organizations that award stock-based awards. We also, as a fact, also is that if you look at the percentage of companies that are not providing stock-based rewards, a large percentage of that also tend to be organizations that might be global and are awarding employees with non-stock-based compensation, but still some form of long-term incentive linked to the parent company stock. So in a nutshell, I think it's important to highlight that the prevalence and importance of this mode of reward is something that has gone up significantly in the country. And the fact also is that if you look at it, it plays the whole reward structure plays very well across both forms. So from an employee perspective, this is a way of compensation that ties in a longer term value creation, wealth creation for an employee based on how the organization has done. And also from a shareholder perspective, it ensures that employees have a sense of ownership, have a clear wealth creation opportunity when they as shareholders also create wealth for themselves. So as a fundamental tool, it is a fantastic tool to drive out any form of agency problems that organizations have, and also ensure that employees at their own level feel motivated and drive performance to the extent possible. Traditionally, it's also been used as a strong retention vehicle. And while given more and more organizations have stock-based compensation, the retentive element of it might not be as much. But as a driver for performance, this clearly is one of the most important elements for in the overall compensation structure. COVID-19 actually has an important impact in this as well. I mean, while employers saw in the last, at least over the course of the first 2 quarters of the year, most employers saw a significant pressure on their compensation costs and the ability to pay compensation costs. A lot of organizations looked at this vehicle, equity compensation, as a way or as a replacement or as a way to conserve cash and still ensure that employees get rewarded in some form or manner. And because fundamentally, and as we will discuss it, this is not a cash expense on the P&L of the organization, and therefore this was a good way for employers to drive performance, create retention, create motivation, while not necessarily spending the cash that was in short supply at that point of time. But then again, it's important to highlight that the benefit of this kind of compensation structure is not just about conserving cash, but like we discussed, there is a wide variety of aspects that drive the strength of this program. I will not spend too much time on this, but I will wanted to turn to Abhay, our industry representative on this conversation. Abhay, you've been working very closely in the design and implementation of these kinds of reward vehicles, and particularly you're seeing this at Urban Company as well. From your perspective, as an early stage organization, how do you see this or the utility of this vehicle as a real life experience?
Thanks, Andy, and firstly, thank you to BCCI and the rest of the panelists for inviting me. You've already covered some very important benefits of ESOPs, especially startups. Startups consider ESOPs or equity as vital tools for building an ownership-driven culture and long-term success. For early-stage startups, ESOPs are non-cash benefits, and that's very vital. They help in attracting and retaining high-quality talent while allowing the startup to preserve cash for and investing in what matters at that stage. And what matters at that stage really is product market fit and building your consumer franchise. So using ESOPs helps preserve cash and also focus resources on what really matters at the life cycle of the company. Also, from an investor point of view, what I've seen is that investors are primarily concerned, on cash burn in the initial stages, and not so much reported accounting profits. So it works for all stakeholders. ESOPs align incentives and they ensure skin in the game. So people really join ESOPs to create, and having a stake in the company helps them be part of the upside from the hard work. Also, significant value creation is possible for employees, especially for employees joined in the early stages and stick it out. If the startup is successful, there is significant value creation possible for them. All of this works and comes together only if the ESOP framework is solid, so that the benefits are realized. And this covers a number of elements. What's the vesting period? What's the vesting price? What are lock-in restrictions? What happens in case an employee exits? What happens to his ESOPs or her ESOPs? Accelerated vesting rules, in case of liquidity event. Making sure that the organization understands the accounting implications of the ESOP plan they design. And also, very important, allowing liquidity to employees prior to listing so that they can realize some of these benefits. And especially important for ESOPs to be employee friendly, at the early stage. So that's my view, Andy. Back to you.
Thank you, Abhay. Thanks for that. I actually wanted to turn to you, Anubhav. You've been designing these kinds of programs for organizations for many years now. And from your perspective, like Abhay was mentioning, there are a variety of different kinds of things that go into making a plan successful and relevant for the organization. So what do you think would be the key criteria when making a choice of what instrument an organization should have?
Thank you, Andy. There is a wide array of instruments and plans possible. Some of the most common instruments being used are stock options, restricted stock units, and stock appreciation rights. Stock appreciation rights could be both cash settled as well as equity settled. Then there may be other plans like employee stock purchase plans where employees are allowed to purchase shares at a discount, uh, or co-investment plans where the employees purchase shares and these shares are locked in for a particular period. And after the lock-in period is over, the employer matched these shares with some free shares in an agreed ratio. Now, this additional match could be based on performance as well. Uh, Now, first criteria while deciding which instrument to use or what plan to implement is defining the objective. That is, what do you want the plan to drive? Uh, just as an example, companies may be at different life cycle stages and may have different kind of investors as well. Some investors, like private equity players, may have a definite line of sight to exit, and valuation increase hence becomes the primary driver. The objective of the plan in this company may contrast drastically with a company which is mature and has a very wide set of shareholders. In this case, the primary objective could be sustained fundamental performance of the company or retention as well. What I'm trying to say is that the choice of instrument and the plan structure depends on what objectives you want to drive through these programs. Now, different instruments, drive different primary objectives. And let me spend some time on each of these and take you through what actually gets driven by each vehicle or each instrument. Uh, Stock options is the most commonly used instrument in India, and specifically, you will see this very popular in the startup companies or early stage companies. The key objective in this case is valuation growth from the date of grant. Uh, the vesting of options can be both time and performance based. It is important to note that under Ind AS, that is the new accounting rules, the stock option will now be expensed over the vesting period, and hence there is a compensation cost. Some industries like insurance have not yet adopted Ind AS, and hence the accounting advantage continues. But some many companies will now realize that this cost is going to hit the P&L and could be significant in nature. These are also most dilutive instrument relative to some of the other instruments like RSUs, and I'll talk about that in a bit. Uh, the second instrument which is commonly used is restricted stock units. Now here the objective primarily is retention. RSU is best suited, for companies where you want to hold the employees back in the organization. It is a full value instrument that is a deep discounted stock option with par value as the exercise price. The restrictions are generally time based in this case. So even if the share price is stagnant or the share price falls a bit, the RSUs remains in the money, which helps drive retention. These are also less dilutive compared to ESOPs, as their fair value is very close to the share price itself. Uh, in a widely held company, it is a little difficult to get an approval on a standalone RSU plan because it provides complete downside protection to the employees, whereas shareholders don't experience the same. So this is generally used in conjunction with stock options and performance shares. Talking about performance shares, this is also like a full value instrument, like a restricted stock unit, but the vesting is linked to performance. Uh, Now, these performance conditions could be internal to the organization, like revenue growth, AUM growth, uh, return on equity, return on capital employed, etc. Or these performance conditions could be external to the organization, like total shareholder return, where the vesting is dependent on how much return your company has given to shareholders vis-a-vis your competitors. I would also like to highlight that the new accounting rules, that is Ind AS, has made a differentiation in expense recognition depending on if the performance condition is internal or external. If the performance condition is internal, uh, the expense can be rolled back if the vesting doesn't happen because of non-achievement of performance goals. Whereas in the case of external conditions, the fair value must be recognized as an expense, irrespective of whether the performance condition has been achieved or not. Another important aspect of performance shares is that the number of shares vesting may vary depending on performance. Typically, there is an upside which is capped at 2x number of target shares, and it can go down to zero if the performance conditions are not being met. Uh, So it's important that you need to identify what are the fundamental levers of value creation and link those to the vesting of the shares. Uh, the last instrument that I'll talk about is stock settled SARS. Now, this is not a very commonly used instrument, probably because of low awareness around it. This works like stock options, and grantee is eligible to get the gain in the share price. Now, rather than giving this appreciation in cash, you would settle the appreciation in shares. So employee eventually get the equity shares of the company. The benefit of these plans are many. For example, employees don't have to worry about the exercise money. There is no cash outflow for the company, and dilution is also lower compared to an ESOP plan. Uh, the stock settled SARS, however, will have to be expensed like a stock option plan from the accounting perspective. Uh, so when we advise clients, we are sensitive to the facts, circumstances, future requirements, and business plans of the company to ensure that right instrument is selected and the plan design is robust. Hence, that level of customization when you're designing the plan is a must.
No, thanks, Anubhav, for that. One of the things that you spoke about, and it's there on the slide as well, very significantly, is this whole point of dilution.
Yeah.
Are there any sort of parameters or principles that one should think about when deciding how much to dilute for management?
Andy, so the answer varies depending on many things in my view. First is what is the objective and what is the plan structure? Is it going to be a one-time plan whereby vesting is linked to a particular event? Secondly, what is the dependency on the leadership team? That is, a value creation to a large extent is attributable to people, or is it attributable to the product or the platform that company has created? Uh, Now, dilution will be higher in the former case and relatively lower in the latter. Uh, One important question is how much should be allocated to CEO as well. Now, the CEO share can range anywhere between 20 to 50% of the total grant, depending on things like how strong is the second line of leaders. Is there a risk of leadership team leaving when the CEO leaves? How tenured is the CEO in the company? Is he a founder CEO or has been hired externally? How much value will potential investors put on continuity of the current CEO and the leadership team? All these nuances play a role in determining the overall pool of options and what shares should go to the CEO and to the leadership team. Uh, but going back to the objectives again, if the objective is to have a share-based plan that commensurate with the industry practice, uh, uh, like annual grants as part of compensation package, the dilution will vary depending on which industry you are in. For example, in the case of banking and IT, you will see a relatively higher dilution compared to some of the other industries like core manufacturing or pharma. The choice of instrument also have an impact on dilution, and that is what you see on the slide in front of you. So in this example, we want to deliver 100 crore of value through stock linked plans, and the number of grant is calculated using the fair value of the instruments. You will see that the stock option provides a higher leverage in a high growth scenario because the growth outpaces the fair value. Uh, while in ESOP, the dilution is 0.57%, the dilution on RSU and performance shares is only 0.20%, which is 67% lower than ESOPs. So whatever method we choose to calculate the grant, the same principles will apply. Obviously, the full value instruments here uh, are much less dilutive compared to vanilla ESOP programs. And that's becoming an important consideration for shareholders, even when it comes to approval of any equity-based plan.
Thanks, Anubhav. Actually, that's an interesting because that summarizes a bit on the choice of plan instruments and the way to structure it. But it's also important to look at it from a regulatory standpoint, I would imagine, to understand the regulations that drive any plan design, particularly because it relates to equity and so on. So, Aarti, I want to turn to you. From your perspective, what are the parameters or what are the regulations that you think one needs to completely be aware of when designing or implementing a plan? And as a matter of fact, one of the questions that has already come into us is also on this. So it will help if you can talk through it.
Sure, Andy, and hi, everybody. The primary objective of any regulatory framework is to ensure that the plans are designed and implemented and operated in a fair and transparent manner, so that the interest of the various stakeholders like shareholders, employees, promoters is protected. Indian companies that are not listed have to definitely consider the provisions of the Companies Act when framing their stock schemes. While in the case of listed companies, one has to take cognizance of the Securities Exchange Board of India, that is the SEBI regulations also, in addition to the Companies Act regulations. So, but since both of these regulations are aligned, hence the compliance should not be a big challenge for companies. What do these regulations provide in particular is guidance around who can receive stock options, to what extent a company can issue stock, and how these can be treated in circumstances like an employee resigning or the death of the employee or he being incapacitated, or when designing the plan, what would be the parameters laid out within which the plan has to be designed. For example, one needs to really note that these stock options cannot be issued to everybody in sundry. There are exclusions like independent directors, consultants, promoters, and directors holding more than 10% stock cannot participate. So there is going to be some kind of restriction, some kind of guidance which these laws provide. I would like to call out that there is an exception carved out for startups for a period of 10 years from incorporation, where the restriction on promoters has been eased out. The SEBI regulations also cover one very important aspect, uh, which is the administration of stock-based incentives through trusts. And this governance is being put in place to ensure that the trusts are not being used as an treasury function by the company. So that's to safeguard the interest of shareholders. After designing, one has to look at the accounting aspects of things. And as far as India is concerned, we have the Indian GAAP or the Indian accounting standards, whatever applies to companies. Indian accounting standards is applicable to companies having a net worth of more than 250 crores, whereas all other entities need to follow the Indian GAAP. ESOP is a cost to company. And hence, because it's a benefit to the employee, so there is a cost associated, and the valuation as well as recording the cost over the period of the plan is absolutely necessary. And for companies which are following the Indian GAAP, the guidelines prescribe that the options have to be measured on the date of grant by using either the fair value or the intrinsic method, and that same has to be recognized over the vesting period of the option. And a fair value of the ESOP is estimated using an option pricing model like the Black-Scholes model or the binomial model. And fair value method is considered more appropriate because it takes into consideration various factors like time value of options, interest rate, volatility. So that's considered a more appropriate valuation uh, as compared to the intrinsic value. Now, under India's, options can be measured only under fair value, and the same is required to be recognized again over the vesting period. Um, One should note that if your stock plan is extended to, say, your branches or overseas subsidiary employees, then there is a requirement under FEMA, which is also necessary. And there is a general permission actually, which is available for companies issuing shares to employees of overseas subsidiaries, uh, which says that the scheme has to be in accordance with the guidelines which are relevant, like Companies Act or SEBI guidelines. And the issue of shares is within the sectorial gap, if any applicable to industries. Also, there could be a reporting requirement where an annual return is required to be filed to the RBI, and the sellers need to ensure that they are remitting back the sale proceeds within a period of 90 days. Uh, in case of subscription to overseas plan, where employees of an Indian company are subscribing to overseas plan because the holding company has extended that plan to the Indian subsidiary, in that case, it's advisable to secure an approval of the RBI. And once we are through with the accounting and the designing aspect, we come to the most difficult aspect, which is taxation. So from a company perspective, if we are to see, there has been a severe amount of litigation in the past as to whether ESOP cost can be treated as a cost to the company and allowed as a deductible expenditure. But I think there have been several decisions in the recent past which clearly call out that discounts under ESOP are employee cost and they should be allowed as a deduction over the vesting period in the hands of the company which is issuing. In case of employees, the tax trigger is in two stages. The first is on allotment of shares, where the spread between the FMV on the date of exercise uh, and the exercise price is treated as a perquisite in the hands of the employees. And the second tax trigger comes at the point of sale, where the sale consideration less the fair market value, which is considered for perquisite taxation, is treated as the gain. So depending on the holding period, the gain will be treated as a long-term or a short-term gain. And there is a valuation norm which is prescribed to determine what is the fair market value at the point of exercise. So in case of listed companies, that's going to be very easy because it's the price which is listed on the stock exchange. But for unlisted companies, one needs to obtain a merchant banker valuation for the purpose. And it's really critical to know here, Andy, that we have a lot of people who are crossing international borders and working on overseas deputations. So in that case, India as well as that other country is going to be trying to tax the benefits. So one has to take the benefit of the double taxation avoidance agreements and make sure that the benefit appropriate to the service period is taxed in respective jurisdictions, and where there has been taxes paid in either of the countries, then credit of taxes could be available. But so that's one part of it. And if any of the employees are holding overseas stock, then it's necessary to report these as assets in your tax return. It's in our experience, what we observe is that there is significant amount of litigation around taxation of stock awards, where companies either fail to withhold taxes or delay this reporting to a certain extent, and hence there is companies need to be cognizant about this, especially if you are a company whose employees are getting benefit or shares from a overseas holding company. And the second part of it, that there needs to be employees also who have to take cognizance of the reporting requirements. Over to you, Andy.
Thanks, Aarti, for that. That's a very detailed analysis from a regulatory perspective. One thing I wanted to check with you, and I want to turn to Mousami for this. One of the challenges, Mousami, we see is that all of this works fairly seamlessly when it is a listed organization. There are very clearly set norms, etc., that exist. How do companies that haven't done an IPO but have issued some form of stock-based instrument to their employees, how do these kinds of companies provide an exit vehicle, exit route for their recipients? Mousami, you're on mute, so you have to probably unmute yourself. Thank you.
Thanks, Andy, and good afternoon, everyone. That's certainly a key challenge for unlisted companies. So in a listed company, what happens is an employee can liquidate some shares to but in an unlisted company, the share does not have a ready market. So employees' exit is often promoter driven. And this sometimes makes the ESOP appear less attractive for an unlisted company employee. So if an employee receives a share, which he is not able to convert into money, that's not so much of an attractive proposition. So it is important to provide for exit routes while designing the plan itself. Exit could either be by way of sale to promoters or to a new investor, or then finally when the shares ultimately list on a stock exchange. What happens is in most ESOP plans, uh, we provide an accelerated vesting of the unvested ESOPs upon a change in control or upon a listing. That is, the unvested ESOPs that an employee holds will vest immediately when a new investor comes or when the company lists on the stock exchange. Another effective vehicle that companies use is also an ESOP trust. The ESOP trust buys the shares when the employee is exiting and holds the shares maybe then to allot to other employees when they exercise shares later on. But by and large, what we see is the exit comes when the company either lists or by way of a sale to promoter. But in most cases, the plan design we see is not made robust enough to provide for all these various exit routes and manage these kind of contingencies. That's what we generally see, Andy.
No, but I think the important thing also, Mousami, is that so how do you define it from a tax perspective? Because while the exit is possible, the allotment of shares is I mean, you're taxed at that point. So how do you fund the tax liability when you're not able to sell the shares immediately?
Absolutely. This is a major issue for unlisted company employees. That's the cash flow challenge on account of the taxing point. So, like Aarti just explained, the taxing point for an ESOP is the allotment of the shares. In a listed company, the employee will sell some shares like a sale to cover the taxes, and he'll hold the balance shares to be disposed of later. But an unlisted company employee does not have this option. So then uh, they have to go out of pocket, even though there is no cash flow at that point because the share itself cannot be sold. And this challenge will only intensify, let's say, if the share value declines later on after the employee has paid tax. Let's say the share value declines and he ultimately sells it at a loss. What it means is the employee has paid tax at the time of allotment on a notional income, which he probably will never realize also. But to address this cash flow challenge, the finance minister made an amendment in section 192 in the last budget. That's the section of the Income Tax Act which deals with withholding tax on salary and on perquisites and stock perquisites. So this amendment provided some relief to eligible startups. The amended section allows an employer of an eligible startup to defer the tax deduction on ESOPs for an employee to a time when either the employee sells the shares or when the employee leaves the company. But the maximum deferral is capped at a 4-year period, 4 financial years from the end of allotment. So that's what the finance minister did last year to help alleviate difficulty. Andy?
I think thanks, Mousami, for that. I hope so. Moushami's voice cracked in a couple of places. I hope you could all hear it. If there are any questions, do please put it in, and we'll try and address it in a bit. But I wanted to turn to you, Abhay. I mean, Mousami spoke about it from a regulatory standpoint. As someone who's been working in this segment, seeing the challenges, do you feel some of these regulations are able to address the real questions that you have?
Sure. So I think Mousami explained in detail the amendments the government brought about last year, and these are really forward-looking steps. But I think the detail lies in the fine print as always. So I'll just spend a couple of minutes on that. I think the first one is that this benefit is available only to employees and on shares of eligible startups. Now, who are eligible startups? Eligible startups need to satisfy a number of conditions. Firstly, they need to be recognized by the DPIIT. They can't be more than 10 years old. Their annual revenue needs to be less than 100 crores. And there's a certification requirement by the interministerial board. So when you put all this together, the number of eligible startups are a handful when compared to the total of startups and unlisted companies in India. As a result, the benefit has actually flowed through to a handful, and not all the intended recipients. Secondly, even when the conditions are met, employees of eligible startups may still be at inconvenience because this is just a deferral. The provision only defers the tax payment by the employee to the liquidity event. The tax is still payable on the fair market value of the shares, as Aarti had explained earlier at the time of allotment, and not the actual gain at the time of liquidation. So in case the share price was higher at the time of allotment but dips later, the employee will still have to pay a perquisite tax on the notional gain as opposed to the actual gain which is realized. So I still think there is scope for improvement, and there is merit on taxing actual gains at the time of liquidation. Back to you, Andy.
No, thank you. Thanks, Abhay. Actually, frankly, what it would appear to anybody who's listening into this is that this is getting increasingly complex in many ways, particularly so for unlisted companies. So, Aarti, I wanted to turn to you from your perspective. Do you see similar questions and challenges globally as well for unlisted companies, or in general for taxation related to equity-based vehicles?
Uh, so, Andy, in general, most countries would tax stock options at the point of exercise. As an exception, the benefit may be taxed at grant or vest, but generally it is taxed at exercise. And as in India, as Mousami and Abhay called out, in many other countries also provide a lot of benefits or a lot of concessions where they treat the plans as qualified. So they have a distinction between qualified and non-qualified plans, and where qualified plans get a favorable tax treatment, say in terms of deferring the tax or a beneficial rate of tax. But in the first place, in order to treat the plan as a qualified plan, it needs to meet some qualifying criteria. And as Abhay called out, a while ago, India also has those qualifying criteria for startups to be eligible for beneficial treatment. Similarly, many of the other countries also, in order to provide entrepreneurial spirit, provide concessions to smaller and newer companies. And to encourage and support them. So this, the benefits that could be extended to such companies could be postponement in the taxing event at the point of sale. So this eases the cash flow burden on the employee, or to tax the actual proceeds that the employee earns, or to pay capital gains tax at a beneficial rate. But there could be a lot of conditions attached on this. And this could be, say, restriction in the number of years the company has been in place. Say, for example, the company should be in existence for, say, less than 5 years or 10 years. There is a cap over there. Or there could be a turnover threshold or an asset threshold. So only companies having a turnover below a certain threshold or an asset base below a certain specified limit would be eligible. There is a significant emphasis in most countries that the company availing of this benefit should be a resident company in that country. Then very specifically, let's say UK has a list of excluded activities like banking, farming, shipbuilding, legal services, who will not be eligible for this beneficial treatment. China seems to restrict companies which are on their negative list from availing benefit under this regime. Or there could be restrictions on employees specifically holding more than 10% shares, and discounts that can be offered. So similar to India, where an approval is mandated, and only those specific companies are eligible for beneficial tax treatment, all other countries also have their specific norms and concessions. And so one needs to remember that if Indian companies are extending their plans to employees of overseas jurisdictions, then they may seek to see whether availing benefits as per these jurisdictions is possible, and they can take the advantage of this kind of thing by having a conditions in the plan design itself, or maybe having a separate country specific addendum per se, so that the employees in those locations are benefited. Over to you, Andy.
Thanks, Aarti. Actually, Abhay, I want to turn to you. This is pre-budget season, and there's also talk that SEBI is looking at modifying, relooking at some of their ESOP guidelines. So, from your perspective as a representative of unlisted early stage technology driven companies, what would be sort of your expectations or things that you would want this budget or the regulations to bring in?
Sure, Andy. I think, and again, some of this has been covered by a few of my panelists earlier. I think 4 clear asks. firstly, shift the taxation incidence from exercise to sale for all unlisted companies, so that employees don't suffer from lack of liquidity. Second, align capital gain rates and classification of short-term or long-term capital gains for listed and unlisted company securities. So there's a wide difference in terms of the rates of tax as well as the period of holding, which puts employees of unlisted companies at a sort of disadvantage. Thirdly, I think, and this I saw some of the questions in the chat box. Allowing promoter ESOPs to be issued so that founders and promoters can also participate in the upside of all the work they do. Else they see their shares being steadily diluted, as multiple rounds of funding happen. And lastly, not directly linked to ESOPs, but a reform ask which is already in the works, with SEBI, clarity on overseas listing guidelines. There is discussion on allowing startups to list overseas directly before listing in India. And once these guidelines are available, and all laws, FEMA, Companies Act, tax, etc., are clear, it would really help startups list and offer employees, a chance to have liquidity on the options they hold. Thank you. Back to you.
Thanks, Abhay. Actually, we've talked about regulations, we've talked about expectations as well, but Anubhav, I wanted to turn to you from your perspective. This contextually, if you look at the current situation, while stock markets have bounced back, they're at all-time highs, but certain sectors are still struggling. And is it advisable? What is the thought process on how should companies look at stock options where the options are completely underwater? The share prices are below their exercise price.
Andy, my first reaction generally is that, is it really required? One of the objectives of a share plan is to align the composition with the outcomes that shareholders experience. And hence, shareholders generally don't take these kind of proposals in a very good light. Now, having said that, we need to consider specific situations. There could be circumstances where executives have created value over the last 6 to 7 years, and the unexercised options granted in the past have become underwater due to reason completely beyond their control. If these options are close to expiry, some of the actions may be considered. Alternatives like value-to-value exchange are relatively much more acceptable to shareholders. Now, in a value-to-value exchange or value-neutral exchange, as we call it, the fair value of underwater options is replaced with new at-the-money options or replaced with RSUs. Now, since this is a value-to-value exchange, there is no additional expense on companies' P&L. This helps in restoring some value for the employees and also releasing some of the shares back to the pool. Some other alternatives like extending the exercise period can also be considered. Any incremental cost due to any such modification will have to be once the options have already vested. The entire expense that accrued due to this modification will have to be taken in the year of modification itself. And this applies to extending the exercise period. This applies to repricing as well. Now, one has to approach this with caution, as shareholders' reaction is generally very averse. If the options have life to go, one should wait and watch. Look at some of the indices today compared to situation in April last year. Many companies are even trending above the pre-COVID levels. So a knee-jerk reaction there was not warranted. And if the companies had taken some action, it would have led to windfall gains for the employees, which is not good from governance standpoint, in my view.
Yeah, just to add to this, see, one must not forget the tax angle when any kind of such exchanges take place, because while the company may believe that there is no variation in the benefit provided to the employees and it's just a pie-to-pie kind of a exchange, from a tax angle, it might be perceived that there is a variation in benefit, and hence one needs to be cognizant of this angle as well.
Thanks, Aarti and Anubhav, for that. Aarti, I wanted to actually close this with you. From your perspective, as we've gone through this entire journey of what of plans, the how, the regulations, the requirements, etc. If you were to summarize and think of what an organization needs to think about, how they need to start thinking about if they want to redesign or implement a new plan structure, what would your advice be?
Uh, I would say, Andy, in this challenging time, it is very obvious that organizations' growth and the employees' personal growth is completely linked. And stock awards is a very important tool to achieve this objective. There's a feeling of ownership that can really do wonders. And especially when the employees are thinking in terms of long-term career aspirations with any organizations, it's a tool which is very effectively used for attracting talent, retaining talent, motivating employees, compensating them, as well as driving employee performance. A multifaceted objective kind of a tool, and irrespective of at whichever stage of maturity the employer is or the company is, this tool can be very effectively used. But it can be only effective if it is designed in a very careful manner, keeping in mind the objectives of the company, long-term, short-term objectives. And because after all, everybody is looking at value, as Anubhav called out, over a point of time, the value of the stock has to enhance and the employees have to benefit by it. Otherwise, there is no fun in it. So, as Anubhav called out earlier, the choice of instruments is going to be critical. One needs to be very cognizant about the pros and cons of each instrument and whether it syncs in with the plans of the company. And Abhay also alluded earlier that when designing the plan, the ESOP framework, the vesting period, the price, all of this needs to be really realistic. There can be reasonable lock-in restrictions, but that may be helpful, but they should not be very stifling in my view. And rules in case of employee exit and accelerated vesting, recognition of accounting standards is really critical. Uh, and one should look at all of these parameters when together with the company value propositions and projections to make sure that stock awards are successful. And last but not the least, it is the tax and regulatory aspect that need to be taken care of. Nobody wants to be in the other side of the law, so that is really critical. One last point over here is that it's important that ESOPs, like employees need to value what they're getting. So they need to be simple to understand and administer, and also there should be a proper messaging to the employees so they really look forward to receiving it as such. So that's the way I would summarize.
Thank you, Aarti, and thank you to all of you. What we'll do is we have about 10 minutes left in this session. So I'll pick up a couple of questions that we have got either directly to us as panelists or as you might have seen in the Q&A box as well. We have tried to address some of them as we can individually also, and some of these questions also got structured within some of the answers that the panelists gave. But one of the questions that I see here is if there are any specific negatives of adopting a trust route from the perspective of administering a plan. So Aarti or Mousami, if you want to take this one up.
I can take that, Andy. So the trust route is actually very beneficial for an unlisted company. And for listed companies, if they want to go into a secondary acquisition, then it is mandated. And it helps companies avoid issue of fresh capital. But then we should also consider the administrative burden of having a trust. There also could be tax implications on the differential that the trust earns. And if shares need to be allotted, let's say, to employees in overseas jurisdiction, then there could be some challenges from a FEMA perspective also, if it's done through a trust. So one has to evaluate, I would say, in each case, and then decide whether the trust is beneficial or not.
Okay. Andy, if I can add on this, one also needs to be cognizant of how much cash is being used to purchase the shares from the secondary market, and over what period of time the company is going to get that cash back. It gets blocked there. So there is an opportunity cost also attached.
Right.
The other thing I wanted to check was a couple of questions that have come in on the plan structures as it applies to international plans, so either employees outside of India or global companies issuing options to Indian employees. So, couple of questions. So first, from a taxation perspective, how are these taxed in India if you are issued a US-based company stock?
So I'll take that, Andy. For a US-based stock, it is similar because it's still compensation in the hands of employees. So the tax treatment in the hands of the employees is absolutely similar, like for an Indian employee. But the difference would be that the overseas plans or the overseas companies will not be treated as listed in India. So which means that the tax treatment would be similar to that of an unlisted stock where the Indian company needs to go in for a valuation of the merchant banker. What we typically see is the tax laws provide a concession for valuation, saying that you can adopt any value which is about 6 months prior to the date of the actual exercise. And what that results into is there could be a difference in the actual price when the employee actually exercises versus the value which the company considers for from the merchant banker. If they are not taking the value as on the date of exercise but taking some prior value, like if the stock is fluctuating greatly, then there could be a difference. But it is very similar to a unlisted company taxation for employees.
So one thing, Anubhav, a question that's come up is, I think, on stock appreciation rights plans vis-a-vis ESOPs. And particularly, I think the question comes up for stock settled SARs, because these tend to look very, very attractive from all perspectives. So where do you see the comparability between the two, and why aren't stock settled SARs more popular?
See, the economic benefit to the employee as far as appreciation in share price is concerned is same in both the cases. The benefit for the employee in stock settled SARs is that they don't need to worry about arranging the exercise money. So employee is free from that. Uh, the second important aspect from the company standpoint is that the dilution is much lower compared to ESOPs. Uh, Now, this has not been very popular in India, primarily because of low awareness around this plan. Uh, the only place where I don't think it works very well is when the company wants more and more shares in the hands of employees, and the objective is to increase the ownership to quite an extent. There, you will probably prefer ESOPs over stock settled SARs. But if the company is looking at preserving cash, preserving shares, while maintaining the benefits of an ESOP plan, stock settled SARs is a very viable instrument to evaluate.
Actually, and that link to that point, Abhay, I wanted to turn to you. I mean, you're seeing this in action. So what are the kind of questions that you get from your employees?
I think two questions actually. The first one is more about awareness, saying when the employee exercises his options, what sort of cash outflow or resources does he or she need to arrange, and that's entirely dependent upon the design of the stock options. Some companies give it at face value, some do it at market value. So that's the first question we get. The second one pertains to treatment of their vested stock options when they quit or resign, and what happens to their lapse, to their stay. So again, like Aarti mentioned, it depends entirely on the design of the plan. Some companies allow employees, even after they quit, to hold on to stock options indefinitely, whereas some require them to excise them within a matter of months. So these are the two things which we typically get asked on our ESOP plans.
Aarti, we got a very specific question on the Karnataka High Court ruling on Biocon. Would you want to address that question?
Sure, Andy. As I spoke earlier also, deductibility of discount for ESOP has been a very litigious issue. And there is reason for that, definitely. See, when a company is issuing stock, there is nothing, no money which is expended out of its pocket. It is a notional expenditure, and it's a contingent liability. There is no, in a traditional sense, there is no expense as such. And this has been the argument of the department all through, saying that discount on issue of stocks, ESOPs, basically is not a deduction or a deductible expenditure under the tax laws. But there have been several decisions in the past which kind of say that expenditure need not be something which is expended out. It can, in a lot of circumstances, include losses also. And discount in case of issue of ESOP is a loss. On a very broad spectrum, one needs to understand that ESOP, the objective of ESOP is to provide additional benefit to the employees. So it's a part of employee compensation, and it's also taxed accordingly. So even though there is some merit in saying it's a contingent liability, it's a notional loss, there is no denial in the fact that there is still some loss that the company incurs, and which is why the same should be allowed to the company. And this is what the Karnataka government Supreme High Court decision also talks about, saying that it is to be it can be allowed as a deduction. And I think as always, there are some areas which the decision does not address. So I think it's opportune time for CBDT to step in and get some kind of clarity around this to put the issue finally to rest.
So we had a couple of questions about employee notional loss, because I mean, you've paid your perquisite tax and the share price comes down, you make a loss. And Mousami was talking about it. I think it's a very valid question, but to all the panelists, is there any way to avoid such a loss? I would imagine no, right?
Everybody would like to have that crystal ball to gaze through, Andy, and avoid losses. But unfortunately, it cannot be so. I would say that you can actually try and restrict the loss if you expect the share price to be falling, and the expectation for the future that it will see a steep decline. Then maybe it's immediately time to sell off. But that's only possible when your stocks are listed. Unfortunately, for unlisted companies, as Abhay also called out, there is no way that the company, I mean the employee rather, can go and sell off immediately. There is no market available. There is either a trust route, which mostly unlisted companies take up, or you have to wait for an investor to come in and buy, or there is promoter sale to promoter that happens. And those are not what I would say flexible options for the employee. So yes, I mean, I'm sorry, I don't have a solution.
Yeah. No, but thank you very much. We have some more questions, but unfortunately, we're at 12:30, and we'll have to close at this point. What we'll try and do is, if you could, we'll try and address these questions separately with the Bombay Chamber of Commerce, and maybe you could pick it up from the representative there, and we'll try our best to address as many questions as we can, which we could not take up today. But thank you very much, everyone, all the panelists who spent time on this, Bombay Chamber of Commerce for organizing this so effectively, and to everybody who attended. I hope you had a informative session, and we look forward to speaking to you again sometime soon. Thank you very much, everyone.
Thank you.